Hi everybody, and welcome back to video 2 on chapter 4, merchandise inventory. And when we left off, we were looking at purchases returns. And here, the example they're showing is that we purchased $250 of merchandise with turns 210 net 60, and on June 3rd, they returned $50 of those goods before paying the invoice. And then when Zmart pays on June 11th, within the discount period, it's going to take the 2% discount only on the $200 remaining balance. That's a place where students sometimes make mistakes. You only get discounts on the goods that you purchase, not the goods that you return. So in this case, initially, we're going to debit inventory and credit accounts payable for the $250. That's pretty straightforward. Then we reduce our payable and reduce our inventory by the $50 purchase return. And then when we pay that, our balance in accounts payable now is $50. Here's the $250 initially, and here's the reduction down to $200. So now I debit accounts payable to wash that balance out, and I have down here, if you can see through my little picture, I have the $4 discount, and then the remaining $196 that I pay in cash. And you again notice that we are reducing merchandise inventory in this case by $4, which is what we paid for that inventory. Not $200, but $196. Okay, a key point here is FOB shipping point and FOB destination. Be sure you have this down. And this is a very nice little graphic that shows you how that works. Here's our shipping point. That's the seller. That's their plant. And we have goods in process, goods in transit, I should say, and then our destination. We're the buyer. So the FOB tells you what you're going to do with this transportation cost and who is responsible for it. So if it's FOB shipping point, that means that the buyer is going to have to pay for this goods in transit, the transportation costs. But if it's FOB destination, then the seller will pay for that. And how do we account for that? Interesting. The buyer, if it's FOB shipping point, the buyer is going to include that cost in its merchandise inventory by debiting inventory and crediting cash to pay for it. We most always pay for transportation costs in cash. But if it's a seller that's paying for it, the seller is going to debit delivery expense and credit cash. No effect on inventory there. Okay? Everybody good? All right. All right, transportation costs then. If we are purchasing FOB shipping point, that means we, the purchaser, the buyer, is responsible for those transportation costs, and we're going to charge that to inventory. So we'll debit merchandise inventory to increase that inventory by the $75 for the freight costs, and credit cash to pay for it. Okay, so how does that look? We're going to have the invoice cost of the purchases. We have the purchase discounts, purchase returns and allowances. These are prompt payment discounts, as I call them. And we're going to add the cost of transportation in, and that's our net cost of those merchandise purchases. Okay? Now, if we look at analyzing and recording transactions from merchandise sales, again using perpetual inventory system. Here is our gross profit. And you want to make sure you know this definition. I will ask you this on the exam. You can take that to the bank. Net sales minus cost of goods sold is gross profit. Okay, so the net sales means that we have reduced the gross sales, let's call it, by discounts, prompt payment discounts, returns, and allowances, which we just talked about. Now, if I'm selling merchandise now, you want to always remember that there's two journal entries associated with that. Two. So there's the revenue side and the cost side. And if I sell something, I'm going to normally debit accounts receivable and credit sales. And at the same time, expense recognition principle, I'm going to debit cost of goods sold and credit, in this case, merchandise inventory. That's my asset inventory is going down. So let's see how that looks. Here's the revenue side. Just like I said, we sold $1,000 of merchandise on credit. And the cost of that merchandise was $300. So I'm going to go sell that, debit accounts receivable, credit sales. Standard journal entry there. We sold these goods on account or on credit. But we don't forget the cost side. Here we have to debit cost of goods sold and credit merchandise inventory. Okay? And again, we book those journal entries at the same time. All right, sales discounts. Now we're shifting to sales. We're the seller now, not the buyer. So sales discounts can benefit a seller by decreasing the delay in getting your cash from that sale, and maybe even reducing collection efforts, because people know that you want to take discounts if you can. It's always a good deal to take discounts. So I, for example, had my programmer come in and change our system so I could tell where we were not taking discounts. And that was something that I looked at regularly until my accounts payable people figured out that was a good idea to always take discounts. So nevertheless, that's what this is showing. So let's take a look at that. Here, I'm going to sell something with a cash discount. Now, again, I don't take the discount or don't recognize the discount until that buyer actually pays within that discount period. So I'm going to do the same journal entries I did before. I'm going to debit accounts receivable, credit sales, debit cost of goods sold, and credit inventory, merchandise inventory for $300. Now, the buyer is going to pay. So we are going to reduce our accounts receivable. It has this $1,000 balance. I'm going to credit it to wash it out, but I only got $980 from this buyer. That goes to an account called sales discounts. This does not affect inventory. See the difference? Whoops. See the difference? Okay. But if the buyer should pay after the discount, then we get the full $1,000 in cash, and we credit accounts receivable to wash that out, if that's the case. Okay. Sales returns and allowances. Same kind of thing. You could argue, let's just reduce sales, the account sales. But we don't do it that way. And the reason we don't, we set up two accounts, sales returns and allowances. Sometimes we combine sales returns and allowances into one account. But we want to know that. That's a problem. If whenever we have a return, that that means I've got a dissatisfied customer. And even though we try to make it right, um, the customer's still going to remember that. I think if you were to go buy an Apple phone at the store and you were real excited about having your new phone, and it didn't work, you'd be kind of irritated. You'd go back and Apple would make it good. They'd give you one that did work, but you'd still be irritated about it. And that's what you don't want. And so I always keep sales returns and allowances separated just for that reason, because I want to investigate why those are occurring and try to prevent them from ever occurring again. In any event, um, uh, they can return the whole goods in this case, and I have to give them the cost side of that back, and I lose the sale, um, the gross profit on that sale. And then, or a sales allowance, I can, give them a reduction in their sales price and they hold on to the merchandise. Okay, so let's see what that looks like. From a journal entry standpoint, I'm going to debit sales returns and allowances. That has the effect of reducing sales. We're going to show it up there with our sales. But that $15 here um, is potentially a problem. But I lost the revenue from that, so I reduced my revenue by that sales returns and allowances. But I also have to remember that I'm returning those goods back into inventory that are not defective. And if they go back into inventory, then I'm going to increase my inventory and credit, that's a good guy, to cost of goods sold. So my true loss on this is $6, the difference between $15 and $9. Okay, so the buyer granted an allowance for defective goods, and that we're going to assume here that $40 of the merchandise sold is defective, but the buyer decides to keep it. So in that case, all I'm going to do is give them a $10 price reduction. That will hit my sales returns and allowances. This one's an allowance. The previous one was a return. But all I'm going to do is debit the sale, return and allowance, and credit cash. There's no cost impact to that. There's no inventory as there was in this example here, because I'm not returning anything to inventory. So my true loss is $10 in this case. Okay? All right. Let's look at some of the adjustments and close accounts for a merchandising company. Now here is a great little graphic. And here we purchase from a supplier, goes to beginning inventory. Here's our available inventory. We do one of two things with it. We sell it. If we sell it, it goes out the door to a customer. We debit cost of goods sold, and that hits the income statement. If we keep it, it stays in inventory here. And that's our ending inventory. And then for the next period, this is period number 2 down here, that ending inventory represents the next period's beginning inventory. And we do the same process again. Okay, shrinkage. Here in shrinkage, we adjust for a loss of merchandise by simply debiting cost of goods sold and crediting merchandise inventory for that shrinkage. That can represent theft, that can represent a number of things, bad accounting or failing to account, those kinds of things. There's new revenue recognition rules that require reporting the sales at net amount, and there's adjusting entries associated with that. Again, I don't emphasize that in my exams. This looks like a good place for us to stop, and when we return, we will look at closing.